All right, we'll get started. I want to thank everyone for joining us tonight. My name is Kenneth Barr, and I'm the Vice President of Marketing here at Connect Credit Union. Tonight, we're joined by George Iglesias, First United Home Loans, and Denise Talboy of Kais. Together, they'll be walking us through our newest seminar, The Roadmap to Homeownership, Navigating Every Step from Start to Finish. Also joining us tonight is Cynthia Ryan, our EVP and COO here at Connect Credit Union, and she'll be assisting us with tonight's Zoom chat. So please make sure if you have any questions, please make sure to put them in the chat, and we'll go over them at the end of the seminar with George and Denise. Thank you again for joining us tonight, and without further ado, I'll hand it off to George to get us started.
Good evening, everyone. My name is George Iglesias with First United Home Loans. First and foremost, I want to thank Cynthia and Scott and Connect for providing First United the opportunity to be their mortgage provider. A little bit about myself. I've actually been in the mortgage industry for 20 plus years, and First United was established in 2009, so we have been around for some time. Our goal is basically to be able to provide low cost and the lowest possible interest rates to our members to be able to provide them with the lowest monthly payment. That being said, I'm going to go ahead and start the workshop of the seminar. And as Ken had mentioned, if there's any questions, please start jotting them down, put them in the chat, and Cynthia can decide if we want to answer those at the end, or if we have time, we can basically stop and answer those questions for you. But as I mentioned, we are the exclusive mortgage provider for Connect Credit Union. We do offer unique products and technology. Give you a little bit of background about that is that there are some lending companies that will either use one underwriting engine or some will use two. In this case, there's two different underwriting engines. One is Fannie Mae, which is Desktop Underwriter, and the other underwriting engine is LP, which is Loan Prospect, which that is Freddie Mac. So it's good to be able to present these files to both engines to see which approval is more favorable for that particular borrower and that particular loan scenario. So everyone will be a little different when it comes to income, credit, so on and so forth. Okay, so we're going to be touching on all the others. Products and as we move along. But one of the things that we're very excited about is we've joined Connect, myself and Kais have brought a Home Partners Plus program that I think will be very, very beneficial to our members. So the overview of what we're going to be covering today, the mortgage process, the loan types. So there's different loan types. Mortgage products, you got the conventional, you got the FHA, you got the VA, and you also have the jumbo loans. There's also other products that I haven't really brought up on this particular workshop or seminar because it's not as needed for the first-time home buyers, but we can touch on that if anyone has questions on other products. Employment history, what are we looking for to be able to approve your loan? Credit types, whether it's traditional credit, whether it's alternative credit. Credit history, of course, very important. The income, what we're looking for when we're trying to qualify a borrower, when it comes to the income, the assets. So there's a bunch of criteria that we're actually looking for to make sure that that individual can repay this loan on a timely manner. So the very first step that any home buyer wants to do is get pre-approved. What is the advantage of getting pre-approved? Well, there's a couple of things that will actually help the borrower, the consumer. One is knowing your buying power, how much home you can actually afford. But one of the biggest key factors is to the borrowers or the consumer is wanting to know what their monthly mortgage payment. So as a loan originator, my job is to obviously approve you for the most I can approve you, but the most important thing is to find out from my borrower what their mortgage budget is. What are they looking for in a housing payment? What do they not want to exceed? Because I may be able to approve you for a lot more, but if you're not comfortable making that payment, then there's really no need trying to get you approved for the max, because of course you have to make the monthly payment. You want to live within your budget. The next thing that we're going to be covering is finding a real estate agent. If you have one, great, you can use that real estate agent. If you don't, then we've got you covered. Like I said, we've teamed up with Kai's. I think they have an excellent product to be able to help our members and the home buyers, consumers. So I think that's going to be something advantageous that you are going to be able to take advantage of. The third piece of the mortgage process is to make an offer. So once I get you pre-approved, you go out there with your professional real estate agent. You're going to start looking for a home. Once you find a home that you actually like and would like to put an offer on, that would be the next step, is to make an offer on the home, which your real estate agent will do all the paperwork for you, guide you through the process. They'll look at all the comps and make sure that the offer that you're making is within that price range that that property is being sold at. Okay, so once that offer gets accepted, that we have a fully executed contract, which means all borrowers, all sellers have agreed to that purchase price. Now we have what's called a fully executed contract. Then we move on to step number 4, which is get your home inspection. Okay, very, very important. Sometimes people want to save a couple $100 and not do that home inspection. I highly do not recommend that, because this is going to be one of the biggest investments in your life, and you want to make sure that you know what you're getting into, whether it's roof issues, whether it's plumbing issues, whether it's electrical issues, whether it's AC issues, anything that is your opportunity to be able to go back to the sellers and renegotiate, for them to either give you a seller credit, for them to do those repairs, for them to be able to lower the purchase price. So these are all things that you can do in that inspection period to renegotiate that purchase price. Once we've done step 4, the next step would be to get a home appraisal. Very crucial in the process, probably the most important part of the process, because the financing is based on the purchase price or the appraised value. Whichever is lower, that's what the financing is based off. So example, you're buying a house at $300,000, it comes back at $285,000, we're going to base the financing off the $285,000. So that's the opportunity for you to go back and renegotiate that purchase price for the $285,000. There has been instances in the past where the sellers say, nope, I want my $300,000. If the property appraised at $285,000 and you still want to buy this property, then you have to overpay that $15,000 if you still want to purchase that property. That was more evident in the past. In today's market, because of the inventory there is, I don't believe that's going to be the case. I do see that more sellers are willing to go ahead and renegotiate to get the lower sales price to move forward and get this deal finalized. Once that appraisal is done, then we move into the next phase, which is secure your loan. That's basically where what I'm working on, is to make sure I have all the proper documentations, all the bank statements, making sure that I've sourced all your deposits, making sure that we have enough funds for the transactions. Once the loan is secured, then we have what's called a commitment letter. That commitment letter has to be provided to the real estate agent per the contract within a certain time frame. Once that commitment letter is issued, then basically the loan has been secured, and now we move to the next phase, which is close the sale. At that point, the loan is closed, everyone signs their documentations, and you, as a homeowner, congratulations, you are now in your new home. So what we'll be reviewing today is obviously the mortgage process, which we just touched on, and the mortgage product information. So these are typically the 4 common products that most buyers will get financing on. One is a conventional loan, which we'll touch on in the next couple of slides. You have also what's called the FHA. The FHA is basically the Federal Housing Administration. The VA basically stands for Veterans Affairs, and the jumbo loan is basically considered a non-conforming loan, so it doesn't meet conventional guidelines. So then that's when we go ahead and provide the jumbo option as an alternative to be able to move forward and purchase the home. Okay, so what is a conventional loan? Typically, anybody that has higher credit scores, this is going to be the better option for you. This particular loan product is not insured by the government. They have down payments as low as 3%. You can give as much as you want, 20, 25, 30%. Of course, if you give less than 20% down, then this particular loan product will require what's called PMI, which is private mortgage insurance. This is not your mortgage insurance for the home. This is basically to protect the lender. In case you would default on your loan, the PMI, the private mortgage insurance, will kick in to absorb the loss with the lender. Okay? Also, like I mentioned, this is for people that have higher credit scores, because if you take this particular loan product with a 620 credit scores, I will tell you that your interest rate and your mortgage insurance will be higher, because conventional loans will hit us with adjustments depending on what your credit scores are. Okay, so this is a quick snapshot on what a conventional loan is. Our next product is going to be the FHA loan, which is the Federal Housing Administration. Okay, this one is backed by the government. So basically the PMI is government insured. Okay, they do have low down payment, as low as 3.5%. Your credit scores, as you can see, they can be a 580, they can be as low as a 500. But if you're between a 500 and a 580, they will require a 10% down, and they will most likely also restrict you on the debt to income ratio. Okay, with a 580 and above, then you can give 3.5% down, and typically our debt to income ratio can go up to 55%. So in our world, we call DTI, it's just an abbreviation for debt to income. Okay, and basically how that's calculated, it's basically calculated on your monthly income and what your monthly obligations are. So what does that mean? That means the new housing payment, plus your credit cards, plus your anything that appears on your credit gets calculated, and we cannot exceed 55% on an FHA loan when it comes to your debt to income ratio if you're 580 and above. Okay, so and again, this is the product for lower credit score people, and this is also for first-time home buyers. So they're more lenient with the lower credit scores. So a lot of my buyers are coming in, they have great income, but their credit scores could be a 620, a 630. I will always present both options to them. I will always give them my professional opinion, but obviously they're the ones to make the determination on which way they want to go. But most of the times, payment-wise, they're going to be better off going with an FHA loan than they can with a conventional loan. Okay, so that's just a little scenario on that loan product. Moving on to the next one, we're going to be talking about the VA, and that's Department of Veterans Affairs. So if you have served in the military, if you're active in the military, or their families, this is a huge benefit for anyone that does have their VA benefits. One, also government-backed. Two, there's no required down payment, so you don't have to give anything. Okay, credit scores, there's no official minimum, but lenders typically would like for you to bid a 620. I have done lower than 620 credit scores on VAs, but one of the biggest benefits is that there's no monthly PMI, the mortgage insurance. So that is huge for our veterans. Okay, so if you have any family member or even yourselves that are thinking of purchasing and they have the VA benefits, definitely a way to go. Okay, so this is definitely huge for our veterans. Okay, and then of course we have the jumbo loans. So anything that exceeds Fannie Mae's loan limit, which has just been increased, and of course due to our market, values have continued to go up. Even though we are seeing a change in the horizon, anything above 806,500 in most areas of the U.S. is exceeding Fannie Mae loan limits. If that is the case, and you're financing, not buying something at 806,500, but actually financing something over 806,500, then this is when the jumbo loan comes into play. Typically, on these types of loans, there's a little bit more risk involved because they're higher loan amounts. The lenders are at risk of losing more money. So typically, they would like for you to put a little bit more money down, a little bit more skin in the game. They're willing to take that risk because you are giving more of a down payment. Credit scores, typically 700 and above. Doesn't mean you may not be able to do one at 680, 690, but like I mentioned, your interest rate's probably going to be a little bit higher. On this particular product, there is no PMI because it's not a conventional conforming loan. This is considered a non-conforming loan. Typically, this is for buyers that are buying more expensive homes, $1 million, $2 million. This is where the jumbo loans would come into play. Okay, moving on to our next slide. So I'm sure all of you have heard, fixed rates, adjustable rates. I've been in this business for 20 plus years, and I can tell you there's not a lot of people that will call me and tell me that they want to do an adjustable rate mortgage, also known as a variable rate, okay? The downside to that is when you do an adjustable rate, obviously being in a volatile market as we are right now, a lot of uncertainty about where rates are going to be going. On this particular product, your principal and interest can change up or down depending on what the interest rates are doing. So for the most part, this is somebody that might want to live in a property short term, or an investor that's just looking to hold this for maybe a year. They are willing to take the chance and go with this kind of product. Okay, for the most part, first-time home buyers, even people that have bought several times, they are looking for stability. They want to know where their principal and interest payment is going to be from month to month. It doesn't matter if your mortgage gets sold from one company to another company to another company, which is quite often in our industry. The main thing to know is that they can sell your mortgage off as many times as they want, but the principal and interest part of that payment will never change over the 30 years or 20 years or 15, depending on what term you decide to go with. That principal and interest will never change over the life of the loan. If your payment changes on a fixed rate, it's always going to be due to taxes and insurances. So that can change from year to year. So of course your payment's going to be adjusted because they have to take those increases into consideration and collect for that. Okay, so this is the most popular type of product when it comes to the principal and interest payment. Okay, so this is what we're seeing in today's world. Like I said, very few variable rates. Back in the past, before the housing crisis, there was all kinds of stated income loans, no income documentation. This was prior to the housing crisis. We're not seeing this as much, but there is a new product, which I'm going to mention for investors, which is called the DSCR, and it basically stands for Debt Service Covered Ratio, where they're just basically looking at the income that that rental property can generate. They don't worry about the borrower's income, but that's something that most first-home buyers won't have access to anyway because they're buying their first home. Okay, so that's just a little snapshot between the fixed, the adjustables, and the loan specialty products. Now, as far as what we're looking for in employment, anytime somebody fills out a loan application, we must show a 2-year work history. It could be that you worked 1 year at one job, half a year at another job, and now you're starting a new job. As long as we can document a 2-year complete work history, that's all we need. We don't need your 5, 10 years previous. As long as we can document 2-year work history, this is all that's needed on the employment side. If you're self-employed, absolutely we can use that self-employed income. As long as, again, we can document a 2-year history, okay? Self-employed, It is a little bit trickier when you're using self-employed, but typically they will require a 2-year business and personal tax returns. The only time that I've seen that they'll ask for 1 year personal and 1 year of business is if you've been established in the business for more than 5 years and you have increasing income from year to year. There has been times where they only require 1 year tax returns. But for the most part, they're always going to want to at least see 2 years of personal and 2 years of business. Okay, and like I touched, we can use the part-time income as long as we can verify it and the likelihood of continuance is good. They will send out a verification of employment for part-time income, and there's a series of questions on this form that they have to answer, and one of them is, what is the likelihood of continuance? If it's good, strong, then absolutely we can take that income into consideration. Okay? Moving on to our next slide is the credit history. Obviously, everything in our industry is based on credit. Even nowadays, to get a job, sometimes they look at your credit. So credit is key when it comes to our industry. The stronger your credit, the better the interest rate. The lower the credit, the higher the interest rate. So keep that in mind, that if there's anything that you need to get going on your credit, it's a good thing to do prior to, coming to get your mortgage application done. There's also tools that we have at our availability that there's something called the rapid rescores, that if a borrower is willing to maybe pay off some debt, there's a tool that we can run to help our borrowers take a look at a plan, a credit plan, and what they would need to do to try and increase those credit scores. There is a cost for that. I'm not sure what that cost is, but I can definitely find out for you. But definitely what they're looking for is at least 3 open trade lines and at least with a minimum of 12 months being reported. Okay? If you don't have what's called traditional credit, then there's always an option to do what's called non-traditional credit. What is non-traditional credit? Non-traditional credit are things that don't appear on your credit report. For instance, automobile insurance. You can do cable bill, cell phone bill, anything that we can document with a bill in your name and show proof of 12 months consecutive timely payments. That is also an option that we can take into consideration for the approval process. Okay? Moving on to our next slide, credit check. Of course, when they check your credit, these are the major derogatories that we must address prior to closing. Tax liens, of course, you can't have a tax lien, because if you have a tax lien and we happen to close on that loan, that tax lien can move in front of our mortgage, so tax liens always have to be paid. Same thing with judgments. Judgments have to be paid. Usually they do appear on the credit report, as well as bankruptcies. Bankruptcies, they must be discharged at least 4 years for conventional, okay? FHA is 2 years from the discharge date, okay? So they must be discharged 4 years for conventional, 2 years for FHA. Recently, I haven't seen a lot of short sales, but when the housing crisis occurred, short sales were huge in our market, okay? Basically, what is a short sale? A short sale is that if you owed the bank, let's say $200,000, and the prices fell, and now you're selling it for less than what you owe the bank, that's what was considered a short sale. It was a lengthy process. The banks had to approve it. Everyone had to agree to it. Sometimes the owner that bought that property, sometimes when they did that short sale, they were still on the hook for the difference that the bank or the lender was short on that payoff. Okay, some of them were forgiven. Every short sale was a little different, but we're not seeing that as much. Okay, foreclosures for conventional, it's 7 years for foreclosure to be able to, that's a timeline that we must wait in order for a home buyer to be able to buy a property again. Okay, and then it's 3 years for FHA. So you can see that foreclosures are definitely worse than bankruptcies. A lot of times people would not add their mortgage in the bankruptcies and they would do a foreclosure. Well, now they had to wait 7 years due to that foreclosure. So these are all things that we must meet this timeline. If any of these derogatory events happen to one, this is what we must wait in order to be able to requalify or reapply or purchase a new home. Income history, of course, very, very important. They want to know, is this income stable? Where is this income? Is this income coming from, there's different sources of the income. You can be getting it from child support. You can be getting it from alimony. I've seen people take dividend income. They're retired. They have $1 million in their 401k. They're able to draw $4,000 or $5,000 every single month. And we can document that you have enough of that 401k income to at least go at least 2, 3, 4, 5 years. That income would also be considered. Okay, so obviously it has to be consistent and it has to be verifiable, so we know that we're in good position to be able to collect on this loan, and that way we can move forward. Commissions, of course, bonuses, we can use overtime, same scenario. As long as there's a history of you collecting these bonuses and you collecting this overtime, same scenario, they will send out a verification of employment to make sure that these bonuses are going to be on forthcoming and the overtime as well. Then we can use all that income to be able to qualify you. Okay, assets that are needed. Obviously, you're going to need assets, funds to be able to put your down payment. You're going to need assets for your closing costs. Your prepaids, what are your prepaids? Your prepaids is basically your odds days interest, which is the day you close until the end of the month. And then you also have your prepaids, which is basically your first year of insurance. Then we have what's called our reserves. You may need reserves depending on everyone's credit situation. I've had many cases where the underwriting engine does not require reserves. Sometimes I have a borrower with lower credit scores, and it'll require 3 months reserves. What does reserves mean? That if your mortgage payment is going to be, let's say, $2,000, and they're asking for 3 months reserves, they want to make sure that you have at least $6,000 after the closing, after the down payment, your closing costs, and everything else, that you have at least 3 months in the bank in case you happen to lose your job, in case you come across some financial hardship. You still have X amount of months in the bank to be able to make this mortgage payment until you get back on your feet. So these are the things that they're looking for to be able to make sure that the borrower has enough funds for the closing. But like I mentioned, the reserve is on a case-by-case basis, okay? Now, of course, the source of funds that you can use, obviously your credit union accounts, your bank accounts, 401k, a gift from an immediate family member. I know it says mom and dad, but it could be grandma, it could be grandpa, it could be seller contributions. So there's many things that we can do to try and help the consumer get into home ownership. Okay, so these are all typically the assets that one would need to be able to move forward and buy their home. Okay. Now, on this slide, I'm going to kick it over to Ms. Talboy, which is with Kai's, Denise, and she's going to actually fill you in on what's going on in our market. But even better than that, she's going to talk about the Home Partner Plus program, which I think is going to be huge to all our members and anyone looking to buy a home. So, Denise, it's all yours.
And before that, do you want to check and see if we have questions on the chat?
On the mortgage side?
Yeah.
No, we're good. Fire away. Hopefully we'll get some.
Okay. My name is Denise Talboy. I work for the corporate office of Kai's Real Estate. First and foremost, I'd like to thank Connect Credit Union and George for the vision to implement programs like these to help their members. I find it incredibly valuable, and hopefully you will too. Just 2 seconds about the Kai's company. Kai's is actually founded in South Florida. We have 4,000 agents, many locations, although we'll discuss Broward right now because we sit here and really for the sake of time, we can help members in Miami, Broward, Palm Beach, um, St. Lucie, and then up the West Coast. So I can answer any questions that you have on locations. Now for Broward County, I mean, if you listen to the media, we're crashing. We're really not, but you'll see by the numbers that there are more opportunities to search for a home now than there was 2 years ago. So the existing home sales for single family detached homes has gone down about 12%. Condos and townhouses down about a little under 20%. Volume, and that is the price of the home. For single families, it's gone down 6%, and then condos and townhomes decreased about under 19%. Now, I want to talk about the homes. Next slide, please. The homes, the active listings. You could see it's gone up about 40%, so it's pretty significant. Months of inventory, and months of inventory means homes that if nobody else took another listing, no other realtor took another listing, it would take, as you see the single family homes, 6 months to sell. Sure, that's considered a seller's market. It may be borderline. I think it's a little bit of a buyer's market too, which is an opportunity for you. Condos and townhomes, about a year to sell a condo these days. I know by my mother's example right now, and that's mainly because of the challenges in the condo and homeowners associations. Now, as you see, there are opportunities for you. So it really is going to take patience. It's going to take an experienced agent to help you navigate the market, and obviously we're there to help. What I do want to talk about is our Home Partners Plus program. Again, thanks to Connect Credit Union that we've established this program, which is, it provides several benefits. Not all Kai's realtors participate. I personally interview each one of them that participates in this program, and the realtor experience for us is critical, and I know that is for you as well. And the realtor through this program must be assigned by my office. So at any point, you can reach out to me. George can find me, Ken and Cynthia can also locate me. So feel free to reach out, and I'll explain what it is. And what it really is, and George was talking about having to bring closing costs and down payment to closing. So that all can accumulate. We provide a 20% of the commission that we receive as a credit at closing to you, which means that since it shows up at closing, you are bringing us money to closing. Okay. In addition to that, we waive our administration fee, which is about $500. But I think the most valuable part of the program, other than the monies, is we help with insurance quotes. So if you're looking with one of our realtors and you're down to a couple properties, we will do the quotes on the insurance. So there's no surprise when you're approaching closing what the cost of insurance on that home is going to be. And I think that is critical, although now the insurance rates are sitting, and in some parts it is lowering a little bit, so that we're no longer in that escalation year over year of insurance costs. They've stabilized, and there's even insurance companies are coming back into the market, which makes it a little bit more competitive. So hopefully that will help ease our insurance issue. But that's going to be a big part to help you in finding your home. Do I have any questions? Yes, Cynthia?
Yep, we have one question. George?
Yeah, so one of the questions is, do we offer USDA loans? Yes, we do. Of course, down in Dade and Broward County, that's not very common because it has to be in a rural area. But we can provide that loan product. It does give you zero down payment. I believe the interest rates are a little bit more aggressive. They're lower. But one of the key factors, yes, it must be in a rural area. But yes, we do have that option for anyone that's looking in a rural area. We can accommodate you on that. Any other questions?
I do comment because I'm always asked, why Kais? Why go with Kais? And number one, we're next year's our 100th anniversary, so we're super excited to celebrate 100 years in South Florida. We've been owned by the same family. We're independently owned since 1964, so there's the stability that you have. And many of our realtors, I've been at the company almost 21 years. Many of our realtors have that tenure as well. So the realtors that we qualify through the program have experience, and there's a minimum required to be part of this program. Obviously, the rebate is important as well because it's going to help you financially to get into that home. And nothing. We really do want to handhold, and I think the critical part, to be frank, is our realtors will work closely together with George to make sure that the communication between all parties is seamless. And that doesn't, and George can get to that doesn't happen many times in our industry. The lender is saying one thing, the realtor is saying another, and in this case, you're going to have a whole team behind you, including the credit union staff, that are going to be all there to support you in this, the biggest purchase of your life.
Excellent, Denise. Excellent. So some of the questions that I get to, and maybe this will trigger some questions from our attendees, is first-time homebuyer programs. So yes, there is a lot of first-time homebuyer programs out there. You have programs through the municipalities, City of Fort Lauderdale. We're actually waiting for one, which is pretty easy to use, which is the Hometown Heroes, which the funds got exhausted probably about 3 or 4 months ago.
Yep.
And the word is, it's not official, but the word is that program should be coming out in July. But the good thing about that program is that they will give you, at least last time it was out, we haven't seen all the details yet. We're hoping it's the same, but they were giving 5% or up to $35,000. Okay, so that is huge incentives. If we can bundle that with the Partners Plus program that Kais is able to provide, I think that is an excellent opportunity for anyone that's thinking of buying to be able to come up with very, very minimal amount of monies out of their pocket. So we're just waiting for the governor to allocate more monies. We're hoping it is in July. So the main thing is that is on a first come, first served basis. So I can tell you that last time it was available, they allocated about $100 million to that program. And I would say that within 6 months, 6 weeks, 6 to 8 weeks, that money was depleted. So it's very important that if anyone's considering in buying a property in the very near future, is to call me. There's no obligation to you. We can set up an appointment. We can go over your credit scenario, is to get you pre-approved. Okay, get you pre-approved, and then obviously I'll hand it off to Denise. Denise can put us in contact with one of their real estate professionals, and get you looking. So if that program becomes available, you're ready to rock and roll. We must have a contract in hand in order to be able to secure those funds. So it is on a first come, first served basis. Okay, and that was one of the easier programs to be able to access. And their debt to income ratio threshold was just like Fannie Mae's, 50%. Okay, talking about these other programs, I'm going to give you a quick scenario. I don't want to take too much of your time because I'm sure everybody wants to get back to their lives. But I was working with a nurse. She was going through the City of Fort Lauderdale. The City of Fort Lauderdale was giving her, I want to say, $10,000, $20,000. She was excited. She went out. We got her approved on an FHA program. Like I mentioned, with the FHA program, we can go up to 55% of your gross monthly income. She found the home. We got the contract. We did everything. She went out. One of the last pieces is go buy your insurance. Well, she went out. She bought her insurance. When we calculated that insurance into her monthly payment, her debt-to-income ratio was like at 48, 49%. Not a problem for us because we're able to go to 55%. When she went back to the city of Fort Lauderdale, the city of Fort Lauderdale basically came back and told her, oops, we can't lend you the money because you've exceeded our threshold of 45%. So she basically could not get those funds. So she basically said, George, I don't care. I don't want to be bound to any program. I want this property. So she decided to go ahead and borrow against her 401k, which most 401ks will let you take money out because buying a home is considered a hardship. So she was able to take some money out of her 401k. She was able to get monies from mom, and that's what we were able to do to be able to finalize this transaction. So there are programs out there, but some programs are a little bit more stringent on what they want or what they need in order to give you those funds, where some of these programs are a little easier. So if that's the only way that you can buy, I'm not going to discourage you. Those programs are out there. If there's a particular city or municipality in the state of Florida that you're considering in buying, you can always contact me. I believe I still have a list of phone numbers that I can provide to you to reach out to that particular city or municipality to see if they have any first-time home buyer funds available. You're probably going to have to go through a first-time home buyer course. A lot of these programs restrict you on the amount of income that the household can make. But again, they're there. If you could take advantage of them, we can work with a lot of those programs. There's some that we can't, but I'll be more than happy to at least point you in the right direction. As a credit union member, whether you use our services or not, we want to make sure that you're in good hands. We want to make sure that you're not misled. And I tell all my members, even if you don't use our services, you're more than welcome to call me, and I'll be more than happy to answer any questions if you have any doubts.
Okay, so I have a two-part question. The first part's for Denise. Since you're in the market and you've seen the rates and the inventory move around, what would you say is the average going price right now for a single-family home in, say, Fort Lauderdale?
That's a great question, and if we include Fort Lauderdale, a little bit of Pompano, and perhaps the incorporated part, I would say you're going to have some options above $450. However, we just helped a client buy a small single family. It was a 3-bed in Davie for $350. I don't know how that miracle came to be, but there's some that exist out there. But I would say you're going to have options above $450. It really depends. I mean, I hate to say a number because then I see these closings come through my desk, and then I see miracles, and they're out there. Sometimes it'll depend on whether are you fixer upper, because a lot of those people don't want the fixer upper. So there's a lot of conditions.
Okay, thank you. And then the second part to George, what would we be looking at as far as like the mortgage payment for something like that in the 450s?
Good question. So I like to give this concept or this figure to all my buyers. So if they're out there running around and looking at purchase prices, how they can simply calculate what their principal and interest is going to be. Keep in mind that the only thing I have control over is what you're going to pay the bank for lending you the money. I don't have control over your taxes. I don't have control over your insurances. Okay, so that's going to depend from property to property. If somebody is pre-qualifying you and they tell you this is what you're going to pay in insurance and this is what you're going to pay in taxes, they're misleading you. Please don't believe them. Okay, I like to use, every county has a tax estimator on their website. Okay, and I urge my consumer, my borrower, to please go out there so they're not caught off guard. I'm going to give you an example. I'm going to get back to your question, Ken. I'm going to give you an example. I've been in my home for 30 years, which is crazy because most people don't last 30 years in their home. But I've been in my home for 30 years. My taxes on my property are probably $3,200 or $3,400, which is extremely low. Okay, if somebody were to come to buy my home today, okay, they would probably end up paying $9,000 to $10,000 in taxes on the same property. Okay, so what happens is a lot of lenders or underwriters, They have gotten better at this, but sometimes they will use the existing seller's taxes, which I feel is very incorrect. So if they qualify you using my taxes of, let's say, $300 or $275 a month, what happens is that next year when they reassess your taxes, your payment is going to go up considerably. You don't know the amount of credit union members that I get, okay, and they call me and they say, oh my God, what am I going to do? I don't know, I'm going to make this payment anymore. And my first question to them is, did the loan officer not educate you and not tell you that this can happen, that your tax is going to go up? Oh no, they didn't tell me. I said, do you want to know why they didn't tell you? Because they don't want to scare you off. They work on commission. And of course, if you back out of the deal, they don't make any money. We're not like that. I'd rather sleep at night, tell you this is what you can expect. So when it happens, you can't come back and say, oh, my loan officer did not tell me this. Okay, so it's very important. But getting back to Ken's question, for every $1,000 that you finance in today's market, you're looking at about $6.60, $6.70. I always tell my borrowers, let's just round it off to make calculation easy, and this is on the high side. Just use $7 for every 1,000. So what does that mean? That if you finance $100,000, you're going to pay principal and interest to the bank for lending you the money about $700. If it's $200,000, you already know it's $1,400. If it's $300,000, it's $2,100 that you're going to pay the bank for lending you the money. It's a little bit less, but let's just use $7. Okay, remember, on top of that $2,100, you have to add taxes, you have to add insurance, you have to add mortgage insurance, and then if you're buying where there's an association, you have to add that association as well. So that payment can start creeping up on you pretty quickly, unfortunately, okay? But to answer this kind of question, it's about $6.60, $6.70 for every $1,000 that you finance in today's market.
And I wouldn't panic. I would really sit with George and have the discussions, and he can go through this. I'll have two more observations, if I may. One is, don't get tempted to use a national lender, because exactly the scenario that George mentioned about not calculating the property taxes correctly, it happens all the time. So you want to sit with a local lender like George. He knows the market. He knows what to say and what to do. I see it all the time. People get enticed by commercials and talking to a national lender, and they just don't know our market. So that's important. And then what I wanted to do is I'd taken that $450,000 home just to give you an idea of what that rebate looks like in dollars and cents. If you're buying and the buy side commission is 2.5, just as an example, if we take 2.5 from the 450, we will base the rebate off the commission of 11,250. The rebate is 2250. So I always say it's not chump change, right? So it really is significant. That's going to help you contribute to your closing costs. And that was my last one.
Absolutely.
Thank you, Denise. Thank you. And if anyone has any other questions, please feel free to unmute yourselves. We'll stay on for a couple of minutes just to take any further questions. But you can just unmute yourself and ask the questions on the Zoom.
So as you all can see on the screen, if you have any questions, you can always reach out to me. As you know, I'm with First United Home Loans, but I'm also the mortgage representative for Connect Credit Union. You got my cell number there. You got my email. I'm usually at Connect. If I need to come in on a certain day that I'm not here, I'll be more than happy to come in and sit with you. A lot of times people just want to do this over the phone. Everything's online. My internet website has application access if you want to do it online. Whatever's easier for you. I know a lot of the younger generation, they're not about brick and mortars coming in, but some people do want to come in. I'm okay. I can meet on weekends. You can call me after hours. I'm usually available. I tell my borrowers, if you get my voicemail, text me, leave me a voicemail. I will get back to you. Questions?
Okay.
Doubts? Concerns? Anything?
All right, well, I think that wraps it up. Again, I'd like to thank George. I'd like to thank Denise. And of course, we here at Connect Credit Union are here for you for any of your needs, whether it be mortgages, savings accounts, checking accounts, etc. CDs, you name it, we got it. But thank you everyone for joining.